And we are live. Hello, everybody. It's exciting to have you. We have a really great session today, all about building billion-dollar businesses. What could be better? I am Allie Wyatt. I am the co-founder and CEO of Female Founder Collective and the 10th House, which is our private membership community. And if you all aren't familiar with the 10th House, we provide a myriad of opportunities to help founders grow and scale their businesses. And in particular, you can find people by stage, by industry, by geography. It is a private membership community, so definitely go and check out our membership page to find out more information and see if you're eligible. But it's a wonderful community of women that help each other grow and thrive. But I'm actually here today to talk about our partnership with Chase. We have Your Profit Playbook, which is our first course we're super excited about that is coming up. But really, we all want financial success, but too many founders have no idea where to start. And this is why we've partnered with our own outsourced CFO, the CEO of Finance Savvy CEO, Marguerite Presley Davis, and JPMorgan Chase to bring Your Profit Playbook, which is a 6-week course. This course offers a pathway to building your financial confidence, your acumen, your know-how, and ultimately a financial plan for your business, which I can speak from experience. There's no more important thing than starting with that. You can sign up today, though, for $100 off of the program. But without further ado, I'm super excited to talk about what we're here to talk about and introduce our guests, Kristina Sicard from JPMorgan Chase. Welcome, Kristina. She is a senior banking consultant focused on minority entrepreneurs and would love for you to tell us a little bit more about what that means and what you do on a day-to-day basis.
Yes, Ali, thank you so much for having me and giving me the opportunity here. And so basically, I work with entrepreneurs. I do two things. I do one on one coaching and mentorship for minority entrepreneurs to show them different areas where we can help them scale their business from A to Z, whether it's operations management, cash flow, capital financial picture, who their trusted advisors are, and business development. And in doing that, we look to achieve the goals that they have set in place with myself. And, we kind of work on a timeline and where we can have achieved those goals and deliverables. And with that, I also do some workshops like this where I try to talk to the larger masses of people because obviously you can't reach everyone with the one on one. We do have consultants in 13 cities and we're adding 5 more. So it is a program that is growing. It's unprecedented for the bank, and so it's something I kind of love to do.
And I didn't know that you all had consultants in 13 different states. That's incredible. So that's very good to know for all of us. But before we, sorry about that. Before we jump in, I want to take a look at the fundraising process, of course. Can you break down what Series A, Series B, C funding means and how each works?
Absolutely. So in the Series A funding, this is where we move past our friends and family startup. And also, our own capital injection, the founders into the business. And so basically, at this point, they've already kind of developed a track record, they've established a product, and now they're looking to bring that product to scale into the marketplace. And so this is where they're going to come with a very good business plan where they can show that they're going to develop long-term goals and develop long-term earnings and revenues so that they can pique the interest of folks and investors who are interested in their service, their product offering, and what they bring to the table. And so the Series A funding, I kind of say, is kind of still part of that implementation stage, getting ready to kind of get off the ground, but you've done your homework, you've kind of narrowed things down, but you need some help to kind of scale and get you to fill the orders across the board. Does that make sense or
Super helpful.
Right, right.
Definitely.
And so as we go on to this series, and so with that, you're gonna find usually, I think in 2020, the average fundraise for Series A was $15 million. And so that's typically where you're looking to kind of, and maybe we'll get into it later, but cover some of the initial costs in terms of getting that product to scale, to market the way you need to in those initial stages. And so, what people definitely want to do is make sure that they have enough to kind of account for all the obstacles, challenges, long-term costs that are going to come up, especially if they're going to make it to their next series of funding, which is the Series B stage of funding. Now, this is where we've done, maybe 18 to 24 months in that first phase of scaling the product, getting it off the ground, taking it where we need to go. And now this is like full forward business development. We're no longer in the kind of implementation stage. We've already had success. We've already seen where we need to go. And so basically, the average cap around here is about $33 million. And now you're focusing around, okay, sales, marketing. What else can I do in terms of business development to take us to the next level and really kind of take the steam that's already rolling and truly, truly make some extended marks in the business. And so when you do that, a lot of times now you're going to start to interest more venture capitalists or people who are interested investors who will say, okay, they typically want to go at the later stage because now they've seen the work, they've seen the accomplishments, and basically they're ready to kind of jump all in. And so when doing that, I think once we now got everything off the ground, we're rolling. If there is a Series C, which everyone doesn't necessarily go to this stage, but if this is a Series C, the company's already made it. They've already done, enormous numbers. They've already kind of capitalized the market. Let's say their market is here in the US. And now they're like, okay, maybe we want to take this over into Europe or go into additional markets and look for places where we can, or maybe we want to acquire a company that's doing similar work as us. And as you acquire that company, they may have a competitive advantage that makes sense for you to come together with your advantage. And so when you're talking about a merger acquisition, that's a big undertaking. And so with the Series C funding, this is where you're really putting your foot to the pavement and you're getting the backing from not only just the typical players, but now you're getting the investment banks, you're getting some of the other secondary market investors and hedge funds, all these different players who now are pretty sure this is a safe bet to kind of invest. And so, and while we have a lot of typical normal venture capitalists, I think we're seeing a lot of growth in terms of not only the types of funds that are developing, but even in the areas in which they're looking at. Typically, I think we look at high tech and tech companies and tech. But a lot of times we're seeing now, especially in the beauty industry, it's starting to become a very lucrative industry where people are starting to get in and really invest. And you look at, a lot of the different companies that are emerging and becoming billion-dollar brands. It's definitely opening up, but obviously there still needs to be that disruptor factor there. But I think there are lots of opportunities for us to expand in terms of how we look at what is the typical, you know, next billionaire business or disruptor business.
So speaking of billionaires, typically when you think about a billion-dollar company, you think of venture backed, right? So how can founders think about angel investors as part of their cap table, or other types of funding to get them to that billion-dollar mark if maybe they're not ready for raising venture? at a pre-seed stage or a seed stage, or in those earlier innings when they might not have product market fit, or they might not have revenue that would allow them to really attract those venture investors you're talking about.
Yeah, so I think there's a lot of opportunity for the angel investors because they are more willing to take a risk and a chance on what they see to be a good um, product or offering or service or whatever it is that you're bringing to the table. And I think with the angel investors, they're willing to put up cash. However, they are looking to kind of have more insight into the company and give a little bit more in terms of helping you develop brand and lending their expertise or whatever they can to the company to help you grow. And so obviously they're still going to look for a lot of the same things. They want to see that for the money that they deploy, that they can see, in 5 to 7 years, they're going to see a return on their investment in cash, right? They may not look for as much equity as in as a venture capitalist might, but at the same time, they may be a little bit more flexible, and it's a lot easier than the hoops that you'll go through in terms of traditional debt financing, where a lot of times what we call pre-revenue companies, companies with an idea but not necessarily generating business. Let's say you have customers who have agreed to buy into your product or who have agreed to, become part of your ecosystem, but it hasn't happened as of yet. When you go into traditional financing, that's not going to be helpful. However, the angels investors are much more flexible and they can give you some opportunity and maybe even pull in other investors.
And just sort of on that note, and I'm veering off topic just a little bit. Are there places, Kristina, that you found are great spots to be able to find angel investors? Because I know a lot of our founders typically ask where to be able to find them, right? Because it seems ideal, right? To have this angel that comes into your life and invests in your company, but also has expertise in it. So, do you have any recommendations?
I think I would probably check with some of Google. Obviously, you can Google some, but in your local area, I would look for maybe clubs, angel investor clubs. Excuse me, I'm so sorry. My allergies are getting to me.
Feel free to take some water. All good.
um,
We're all having sicknesses roll through. It's that time of year.
Absolutely. But I also think checking your local business centers or different banking partners that you may have. I think a lot of times they have leads into folks in your area and their network that can actually help you identify who some of these key players may be in your particular market. So I think number one is having relationships. Um, Especially with your bankers. I think they're some of the most, they can actually point you towards some of their own clients who may fall
Yeah.
into this bracket. And I think from there you can start to really find some opportunities to make connections and see, get to know folks. But networking, number one, is like always be networking, LinkedIn, um, a lot of different places like that.
Thank you. That's super helpful. Um, the other avenue that I want to talk about is, of course, private equity. What are your thoughts on private equity and when you go to try to get private equity type of funding versus going and getting angel funding versus venture capital? How do you think about what is appropriate for your business and your stage?
So I think private equity is more for the mature companies who've been around for quite a while, who basically private equity, they're more so looking at companies and seeing how can they come in and make a difference in a company, right? So a lot of time with private equity, they may come in and look to make changes or revision or re-image how a company looks and rebrand it, maybe make certain changes. make additions, break things up, add certain things. And so I think that's more for when a company has really matured. And I think that you're ready for that kind of analysis, paralysis, like, in depth kind of, look into your business in terms of what can we do different? We've done a lot of things already. What can we add to this table? And, private equity is also looking for those that have mature, accomplishments and have shown revenue, and really they're looking to invest in that company that has track records already there, and maybe look to see where can they make the tweaks or do different things to really take it from, they've been past the explosive growth, and now maybe the growth is not as quick as it was initially. So how can we take that slow growth company and, like, now fast forward it back to some more additional growth incrementally?
Almost like value engineering too,
Right.
right? Finding the inefficiencies and figuring out how to maneuver them so that you have a lot better output. And then another huge aspect of reaching the $1 billion mark is often debt financing. What is debt financing? I'll start with that because a lot of people don't know. And then what type of company is right for it?
Yeah, debt financing is where you're basically going to take on a note or some type of, funding where you're going to have to repay the funds at whatever rate was, kind of like a bank loan or some other type of, loans, from, if it's even venture debt, or, there's tons of companies who offer debt. But a lot of time that's going to be based on cash flow of the business, right? What is your repayment opportunity? Can you cover the debt service coverage? And so for a pre-startup company, pre-revenue company in the startup phase, a lot of time it's difficult and challenging for them to say, we're going to be in the red for the first 3 years. Then 3 years, you're not going to really show the cash flow because you're burning cash. And so debt financing is definitely going to be for that company, again, that's a little more established, that has cash flow, that can take on these types of notes or things in order to, maybe make some certain jumps or leaps that they want to do without giving up equity, which is, a lot of folks want to do that, because we talked about all this great stuff with money, but with equity venture capital, you're giving up, part ownership of your business, you're giving up control, flexibility. You have to be willing to work with the venture capitalists or the angel investors or the board members they pick, or the differences of opinion, and you have to, make sure you mesh well with them, and that you can have a good working relationship. And so usually a company likes debt financing when they're like, hey, I'd rather keep my own equity, take on the debt on my own balance sheet, and, do what I want to do moving forward. So definitely the company that's, mature enough, has the cash flow, and says, hey, I want to have flexibility, and I don't want to give up the rights and ownership of my company.
And as far as debt financing goes, is a small business loan, for example, could that be a debt financing instrument?
Absolutely.
Great. And is there a little more detail you could provide in terms of what does a company need to provide in order to get a small business loan?
In order to get a small business loan, they're going to need to provide usually 2 to 3 years of financials. They're going to want to show positive net income. We're gonna look at the credit, the cash flow of the business, as well as what collateral do they have. And usually there's going to be it's a simple formula as to whether they can cover the debt service, that they're looking for, based on the cash flow of the business. So it's not going to be based on future earnings, or, we don't do, it's totally, what is the cash flow of the business today. And so we're going to look at your personal returns as well, personal financial statement. What are your personal obligations? Because any type of debt financing for a small business loan is going to require a personal guarantee as
Mm,
well. So personal credit impacts the application as well, which a lot of business owners are not aware of, as well as their personal debt. If they have more, a lot of cars and mortgages and
right.
doing a lot of spending on the personal side, that is also going to impact you on the business side if you're looking to do some type of debt financing.
So long story short, make sure your credit score is great on on the personal front before you go out and start your small business, or get your loan. What about non-dilutive capital and or government funding? When should these come into play, and what kind of companies might be a match for this sort of capital?
Yeah, non-dilutive companies, non-dilutive capital is capital that's being deployed either through a business development corporation or government in order to kind of initiate some sort of overall, influence in terms of maybe they want to see more tech, companies in a specific healthcare field, or maybe they want to inspire business growth in a different type of field. And so what they'll do is they'll provide capital which doesn't require an equity return on it. And so that's what you call non-dilutive capital. And so depending, a lot of times government will have science research, initiatives they'd like to, progress along. And so they'll look to back different companies. Recently, Google put I believe about 175 million towards minority entrepreneur black owned companies to help them in terms of growing support due to all of the social unrest that we saw recently. And so I think this type of funding is good for all types of company. I think for whether it's a startup company or maybe an advanced company that has some new, tech product that might be in line with some of these initiatives that you see. And what's better than receiving capital but not necessarily having to give up ownership for it? And so there's definitely tons of opportunity here in this market.
And can you mix these different types of funding at different stages? So, for example, if you had gone out and received venture funding for a pre-seed round, and then you decided, you know what, I think that I want to go after some grant capital because I have a very sort of science-driven product and company that I'm bringing to market. It might make sense for me to get a grant. Is that possible to do?
Yes. I think you can. I do think that although again you have to defer back to what kind of stipulations you put in, because you may do venture capital, but they'll say, well, we don't want any debt financing, with this with what we have. So it's all going to be within the parameters that you created again at the beginning of the relationship. I don't see why anyone would turn down grant funds. However, there might be something in the bylaws that says no, we can't. So I think it's going to really be
Right.
on a scenario basis in terms of what the founders and their investors agree upon.
Got it. So that's a good reminder for founders to make sure they're looking through those terms and thinking sort of down the line of what is the strategy of my business? Where do I want to take it? What's the vision? So they can ensure that they're setting themselves up for maximum opportunity when it comes to funding. And then you talk a lot about collaboration and how important that is in order for businesses to succeed. Can you speak to what you mean by that and what collaboration means to you and how businesses should think about it?
Absolutely. I think everyone thinks competition versus collaboration, right? I think if two leaders in their industry get together and maybe look to collaborate, on a lower level, the lower scale, they could maybe learn different things from one another, help one another. And I think when you collaborate that way, you can kind of have some really great success. If two great companies come together and merge, they may be able to corner the market in a better way than they did individually as well. So a lot of times I think businesses always think, how can I always beat my competitor versus, well, what if we look at opportunities to collaborate and see what can we come up with, and maybe both of those two in founders, companies, corporations, they could come together and really maximize their offerings in one offering, or just take it as an opportunity to grow. I think I grew up always, my father always instilled in me, hey, you always look to others, your elders or your peers or other folks doing things you're interested in doing or similar to what you're doing, to find out what's working well for them. And I think if founders and businesses take this, into account in you know, their daily interactions, that they'll find some value in it as well.
And then, Kristina, as far as sort of a founder and how they're thinking about how much cash they should have on hand, how they should be managing their business financially, right? Which is a big part of the course that we've introduced together. How should they think about, the amount of money they should raise, and when to know when to go out and get funding?
Yeah, so I think number one, you're gonna need to look at doing a cash flow statement and looking at your monthly projections of what are your expenses, what are your cost of goods, what does your income projections look like, and how much money are you going to be burning on a monthly basis. And you want to do that for a good 18 to 24 months. And I think once you do that, then you maybe want to add a buffer. Some people may say 50%. I don't know. But
50.
I know, right? I've seen some people say that. I'm like, that's a lot. But to that point, that's also a risky thing to do, because if you have an over evaluation of your business or what your costs are going to be, that could potentially hurt you as you go in and look to meet with investors if they see numbers that look obscene. So you want to have a best case scenario, a medium, tolerable level, and then okay, absolutely necessary. This is what I
Yeah,
need, and you want to find a fall in between. But it's very important to be realistic about what your monthly expenses are, and to kind of have maybe 2 to 3 options in terms of what you think your actual income is going to be on a monthly basis, and how those numbers offset one another. And that's going to determine, based on whatever your burn rate is on a monthly basis, how much you should be looking for.
got it. Super, super helpful for us all to have those very concrete things that we need to be thinking about. And then, we're almost up on time, but I do have a final question. And that's that, you meet with so many founders, right, on a regular basis, and business owners. And so you get to see sort of the differences between success and failures, and you witness them going through these very difficult decisions that they have to make. What are some of the most salient pieces of advice that you've heard founders give each other or tell you about, or that you give them, that they say has been so transformative for their particular business?
I think having a really good business plan, in terms of a working plan, but it doesn't need to be like the 20 pager,
Yeah.
like, I mean, like the short version of what you need to focus on. And this way, something that you look at on a consistent basis, and can
Yeah.
come back to, and can kind of always help you reevaluate where you are. Like if you get lost, it pulls you back in to where you want to go. And if you have an off
Right.
day, or something led you off track, if you have the goal now, okay, this didn't work, but well, let me just rethink, how can I achieve what I initially set out to do, and stick to where you were, and make changes like as things don't work, add something new, take things away. But I just think having a very, well set business plan that you can articulate quickly, in front of people as well, not just on paper, and that you can always refer back to help you in your day to day as things change and get cumbersome and obstacles arise.
Well, that is something that I would also agree with wholeheartedly, right? Having that business plan does bring me back to the whole purpose of our partnership, which is putting that in place, right? Knowing your financial statements and having a financial plan that you can use as your roadmap. And it doesn't have to be fixed in stone. But as you said, it helps you understand your guideposts and where you need to be at a given time. So definitely, again, check out our Your Profit Playbook course with Marguerite Presley Davis. And thank you all for joining us. And thank you so much, Kristina, for sharing your wisdom. We're very grateful.
Thank you so much, Ali. I really enjoyed the conversation, and thank you for having me.
All right. Bye, everyone.